We like to think of the modern global economy as this, I don't know, this completely weightless, frictionless thing.
Right, like it's just floating up there in the cloud.
Exactly. It is so easy to imagine our financial markets as this pristine digital cloud of ones and zeros, just moving at the speed of light, totally detached from the physical dirt and grind of the
Oh,
earth.
for sure. I mean, the illusion of that mathematical vacuum is incredibly powerful.
It really is. You log into an app, you press a button, and boom, capital flows across the globe instantly. We've basically engineered our user interfaces to hide all the physical infrastructure.
Yeah, we hide all the messy stuff that actually makes those instant transactions possible.
But then something happens that just shatters that illusion. A physical choke point gets squeezed in the real world, and suddenly you realize that this entire infinite digital cloud is actually running on a very finite, very fragile network.
Yeah, a network of deep-sea cables, diesel generators, and ocean shipping lanes.
Exactly. And when the physical world reasserts its dominance like that, the financial markets don't just react. They completely pull back the curtain and reveal their underlying wiring. So, welcome to the week that was.
I'm glad to be here for this one. It's been wild.
Our mission for you today is to cut through all the noise of this daily market volatility. We want to help you understand the hidden mechanics connecting physical energy shocks, massive institutional capital flows, and global geopolitical crises.
Because the landscape we're navigating right now is just completely defined by this massive collision between physical constraints and digital assets.
Right. And just to set the stage, we're looking at a market week that began with Bitcoin testing that resistance level around $71,000, fueled by all this early optimism.
Yeah, but then it ended with this heavy slide down towards $66,000. And that slide, it wasn't just random market jitters.
No, it was a totally mechanical reaction. It was driven by massive options expirations and this really fascinating tug of war between retreating traditional macroeconomic funds and highly aggressive corporate buyers.
But I mean, to really understand those digital asset markets, we actually have to start by looking at the physical world. Capital flows always react to physical supply chain threats first.
Always. And the escalation we saw in the Middle East this week was severe. Specifically, we're talking about the progression of Operation True Promise 4.
Right, escalating all the way from wave 78 through wave 84.
Yeah. And the military operations involved these highly coordinated ballistic missiles and suicide drones, and they were targeting Israeli military and strategic hubs.
Very specific hubs, including areas right near the Nuclear Research Center in Dimona and residential zones in Tel Aviv.
But the tactical reality on the ground expanded well beyond those borders, didn't it?
Oh, absolutely. The strikes targeted United States military bases across Kuwait, Bahrain, and the United Arab Emirates.
And there was that highly specific strike at the Al-Kharj base in Saudi Arabia, right?
Yeah, which was a huge deal because it resulted in the destruction of U.S. aerial refueling aircraft.
Yeah.
And then, the retaliatory strikes were equally targeted at strategic infrastructure.
Hitting the Iranian naval facilities in Yaz.
Right, the ones known to produce naval mines.
Mm.
Plus the heavy water complex in Iraq. But the really critical economic element here, the mechanism that instantly translates all this localized physical conflict into global financial panic.
Is the physical blockade of the Strait of Hormuz.
Exactly.
The Strait of Hormuz is essentially the global economy's jugular vein. It is this narrow geographic choke point, and when it gets squeezed, the extremities of the global system instantly lose circulation.
I mean, we are talking about the transit route for 20 million barrels of crude oil every
Right.
single day.
20 million. It's almost hard to wrap your head around. And the ripple effects of a squeezed energy jugular are just immediate and totally mechanical.
Yeah, look at the Republic of the Philippines. They were literally forced to declare a national energy emergency this week.
Under Executive Order number 110, right?
Yep. They had to implement strict fuel conservation protocols. They even rolled back their environmental standards to reintroduce Euro 2 grade petroleum just to keep the lights on.
Just to keep their transportation networks functioning. It really illustrates how rapidly a disruption in the Middle East forces a developing nation in Southeast Asia to alter its environmental policy just to survive.
It's all connected.
So, in a world of highly digitized, 24/7 finance, how does raw physical thermodynamic energy still dictate global market panic to this degree?
Well, because energy is the absolute base layer of the economy. Literally everything else is a derivative of it.
Right.
So when traditional macroeconomic allocators see a credible threat to 20 million barrels of oil a day, their risk models are just programmed to flash red. They don't wait to see how the geopolitical chess match plays out.
Because their mandate is capital preservation.
Exactly. So they mechanically de-risk. They pull fiat liquidity out of volatile assets because historically, an energy shock always precedes widespread inflation and slowed economic growth.
And that mechanical de-risking leads us directly into the massive capital migration we witnessed. Because when the physical world panics, capital moves. But we didn't see a blanket market-wide sell-off. We saw two completely opposite reactions from two very different types of institutional investors.
Right. First, you had the traditional finance exodus.
Which was staggering. We tracked massive outflows from the U.S. spot exchange-traded funds. By the end of the week, there was a $225.5 million outflow in a single session.
Yeah, BlackRock's iShares Bitcoin Trust alone lost over $200 million in one day.
Wow.
These registered investment advisors were basically using the frictionless liquidity of regulated ETFs to instantly reduce their exposure to the geopolitical uncertainty.
But I have to push back on the logic of the market here for a second. If these massive, highly sophisticated traditional fiduciaries are liquidating their ETF positions because of Middle East uncertainty, why are corporate treasuries stepping in to catch a falling knife?
That is the million-dollar question.
Right, because you have Strategy Inc. announcing a massive expansion of their at-the-market issuance capacity. They're looking to raise $44.1 billion across common and preferred stock programs just to buy more Bitcoin.
It sounds crazy on the surface.
It does. Are these corporations just being reckless, or do they fundamentally misunderstand the risk environment that the traditional funds are reacting to?
Actually, it's neither. They are operating on entirely different incentive structures and time horizons.
Okay, unpack that.
Well, traditional finance allocators are operating on a quarterly or sometimes even daily risk-adjusted timeline. They're judged on their monthly performance against a benchmark. Right?
Because they have to react to the news cycle.
Exactly. But corporate treasuries operating on a Bitcoin standard, they're looking at a multi-decade timeline. They view fiat currency debasement as a mathematical certainty.
Ah. So when a supply shock like the Strait of Hormuz blockade occurs,
they know it will inevitably lead to higher energy costs, which eventually forces sovereign governments to print more money to subsidize those costs and keep their economies afloat.
So the corporations see the short-term panic sell-off by traditional funds as basically an artificial liquidity event.
Yes, a temporary discount. It allows them to accumulate more of a scarce asset.
That perfectly explains the aggression behind the H100 Group deal in Europe.
Oh, that deal was fascinating.
It really was. They executed an all-stock transaction to acquire Norwegian firms, essentially building a treasury of 3,500 Bitcoin.
And the financial engineering behind it is brilliant. It's a Bitcoin for Bitcoin structure.
Right, because by using an all-stock transaction where the underlying collateral is identical, the ratio of contributed collateral dictates the equity ownership in the new entity.
Exactly. And because no one is actually cashing out into fiat currency, the founders of the acquired companies don't trigger a taxable liquidation event.
They maintain their exposure to the asset while legally sidestepping capital gains taxes.
It treats the digital asset exactly like pristine traditional collateral.
And we are seeing that concept of pristine collateral migrate right into mainstream consumer finance, too. Fannie Mae just announced they'll begin accepting Bitcoin and USDC for standard conforming home mortgages.
Partnered with Coinbase, yeah.
Right. This allows home buyers to pledge their digital assets as collateral for a house without having to sell them. So just like the H100 deal, the borrower avoids realizing capital gains taxes.
Meanwhile, you have Morgan Stanley undercutting the entire ETF market by announcing a 0.14% management fee on their new spot Bitcoin ETFs.
Which is wild. Morgan Stanley fighting for ETF market share while other traditional funds are fleeing. It perfectly illustrates the internal conflict within legacy finance right now.
The infrastructure providers know the long-term trend is integration, even if the short-term traders are hitting the panic button.
But wait, if these massive corporations and infrastructure providers are buying billions of dollars worth of the asset, you have to ask, why did the price actually grind down towards $66,000?
Yeah, this is where we really have to look under the hood at the hidden plumbing of the market, specifically the options expiry.
Right, because the spot price of an asset is heavily influenced by the derivatives market.
Heavily. And this week, a $14 billion options expiration occurred on the IBIT exchange.
$14 billion.
Yeah. And the critical metric to understand here is max pain, which was sitting at $75,000.
Okay, for anyone not familiar, max pain is basically the strike price where the highest volume of options contracts, both calls and puts, would expire completely worthless, right?
Exactly. That is the ideal scenario for the institutional market makers who write these options, because they get to pocket all the premiums paid by the traders without actually having to pay out on the contracts.
I always like to visualize the options market like a gravitational orbit. Max pain is the center of gravity. When the price is close to it, things are relatively stable because of the mass of all those contracts.
That's a great way to put it.
But when the spot price escapes that gravity, which it did this week by dropping into the 60s due to the geopolitical news, it creates this chaotic vacuum.
Right, and the mechanism driving that vacuum is dynamic hedging.
Walk through that.
So when the price is hovering near a strike price, market makers have to constantly buy and sell the underlying asset Bitcoin, in this case, just to hedge their own risk. If the price is rising toward a call option they sold, they buy spot Bitcoin so they aren't caught empty-handed if the contract is exercised.
Makes sense.
But when the spot price plummeted well below that $75,000 max pain level, all those call options just fell completely out of the money.
So the market makers suddenly didn't need to hedge anymore.
Exactly. They just stopped buying the underlying asset. And the sudden evaporation of that buying pressure totally removed the floor from the market, triggering a cascade of forced derivative liquidations.
A massive cascade.
Oh, yeah.
Over $336 million in forced closures happened in a single day.
Yeah, liquidating over 173,000 individual traders.
Brutal. But it wasn't just leveraged traders feeling the squeeze. The physical infrastructure providers, the miners who actually secure the network, faced major capitulation.
Yeah, the miners got hit hard.
MRA Holdings sold 15,133 Bitcoin onto the open market. That generated about $1.1 billion in cash. And obviously, selling that much supply puts a really heavy ceiling on the press.
But MRA executed that sale to manage their balance sheet mechanics. They actually used that $1.1 billion in cash to repurchase their own outstanding convertible senior notes at a 9% discount to par value.
Right, and a convertible note is essentially corporate debt that can eventually be turned into shares of the company's stock.
Exactly. So by buying back this debt at a discount before it matures or converts, MRA secures millions in immediate cash savings. And probably more importantly, they protect their current shareholders from future equity dilution.
It's a highly strategic corporate finance maneuver.
It is. But the mechanism requires dumping massive amounts of Bitcoin supply onto the spot market to fund it. And Bitdeer, another major miner, went even further. They liquidated all of their recently mined supply, holding a zero balance in their treasury.
Which really highlights the inescapable physical cost of digital assets. I mean, these mining companies have to pay for hardware, cooling systems, and massive, massive amounts of electricity.
And they are now facing a brand new competitor for that exact same thermodynamic energy, artificial intelligence.
Oh, this is the really crazy part. Elon Musk recently clarified that his Austin Gigafactory, which focuses on 2-nanometer process technology, is just a small prototype.
Just a prototype.
Yeah, the true project, which he dubbed Terafab, is targeting 100 million square feet of space and 1 terawatt of computing power.
1 terawatt. That is practically incomprehensible.
It is. We are talking about the energy equivalent of multiple large-scale nuclear reactors, literally enough to power entire small countries, all dedicated to a single computing facility.
And the capital costs for Terafab are estimated in the trillions. This infrastructure will consume the exact same semiconductor manufacturing lines, the same industrial cooling systems, and the same electrical grid capacity that Bitcoin miners rely on.
Right, so AI and crypto mining are fundamentally competing for the exact same physical thermodynamic energy.
Yeah, and the AI companies have a distinct advantage here. Their software services generate significantly higher profit margins than mining a digital commodity.
So an AI data center can afford to pay substantially more per kilowatt hour for electricity.
Exactly. If grid capacity becomes scarce, the miners simply get priced out of the market by the AI firms.
And the urgency to build out this AI compute is just reaching a fever pitch right now, especially regarding security.
Oh, you mean the Anthropic leak?
Yes. The Claude Minos documents. That data leak this week revealed an unreleased AI model with autonomous vulnerability hunting capabilities.
Which is terrifying.
It is. And that leak alone triggered a massive flash crash in traditional cybersecurity equities, like CrowdStrike and Palo Alto networks.
Because the market instantly realized that AI is evolving into this autonomous infrastructure layer that's capable of outpacing existing human-designed security protocols.
Right. And with AI and digital assets demanding these just unprecedented amounts of capital, hardware, and physical energy, the United States regulatory apparatus is frantically scrambling to build a container to govern it all.
And the friction in Washington is immense right now. Just look at the delayed markup of the Digital Asset Market Clarity Act.
Yeah, this bill was meant to establish a comprehensive market structure, but it hit a major roadblock regarding stablecoins.
Right. The resulting compromise in the draft legislation strictly bans passive yield for holding dollar-pegged stablecoins.
Which is really interesting. Looking at the Clarity Act, a skeptic might argue that traditional commercial banks are simply building a legislative moat to protect their own deposit base from free market competition, rather than genuinely trying to protect the consumer.
It definitely looks like that from the outside.
I mean, why should it be illegal for someone to earn a 4% yield on a digital dollar held in their own private wallet?
Well, you really have to look at the systemic risk models the legislators are viewing behind closed doors.
Okay, what are they saying?
If a digital dollar can offer a 4% passive yield without the overhead costs or regulatory constraints of a traditional bank, the incentive to keep your money in a standard checking account earning zero interest just completely disappears.
Naturally.
Right. And forensic analyses presented to lawmakers modeled this exact scenario. They warned of a potential immediate flight of up to $6.6 trillion in commercial bank deposits migrating over to crypto platforms.
6.6 trillion, that is massive.
That level of sudden capital flight would hollow out the traditional banking sector overnight. It would severely restrict their ability to issue loans for things like mortgages or small businesses. So the banks argue that unregulated passive yield causes this catastrophic deposit flight that threatens the broader economy. So the legislative compromise permits activity-based rewards, like getting paid for actively processing transactions, but it outlaws simply holding a stablecoin to earn passive interest.
Preserving the traditional bank's monopoly on deposit yield.
Exactly.
Well, while Congress debates how to build fences around stablecoins, the regulatory agencies made a definitive move regarding the assets themselves.
Yeah, this was a big development. The SEC and the CFTC issued joint interpretive guidance officially classifying 16 digital assets as digital commodities.
Including Bitcoin, Ethereum, and Solana.
Right. This formally shields those specific assets from SEC enforcement actions related to unregistered securities offerings.
And clearing that regulatory runway is exactly what the massive traditional clearinghouses were waiting for. I mean, look at the Intercontinental Exchange, the company that literally owns the New York Stock Exchange.
Yep. They finalized a massive investment this week, bringing their total funding into the Poly Market platform to $1.6 billion.
Which is huge. They intend to distribute the platform's event-driven prediction data globally, and they also took a minority stake in OKX to license pricing data for regulated futures.
It just shows that legacy finance is aggressively acquiring the infrastructure of the digital asset space, regardless of the short-term price action we're seeing on the charts.
Completely. So, let's synthesize everything we've covered this week for you. We have essentially traced this remarkable mechanical domino effect connecting the physical and digital worlds.
It really is a domino effect.
Right. Physical missiles flying over the Strait of Hormuz led directly to global energy panics. That panic triggered mechanical ETF sell-offs from traditional macroeconomic funds trying to preserve their capital.
And then that selling created a liquidity vacuum,
which was immediately filled by corporate treasuries playing a multi-decade game against fiat debasement.
Yep. Meanwhile, the options market mathematically forced out all those leveraged traders.
And the miners liquidated their treasuries to restructure their debt and prepare for this massive thermodynamic energy war against artificial intelligence.
All while Washington is frantically trying to legislate a firewall to protect the legacy banking system from the unstoppable efficiency of stablecoins.
It's just an unbelievable web of interconnected systems.
But, amidst all of this global geopolitical chaos, the military blockades, the regulatory wrangling, and the multi-billion-dollar corporate maneuvering, something else happened this week that I think perfectly illustrates the unique nature of this technology.
Oh, what's that?
A single Satoshi-era wallet. A digital address that had sat completely dormant for 13 years suddenly woke up.
Wait, really? After 13 years?
Yep. With just a few keystrokes, whoever controls that wallet moved $85 million worth of Bitcoin into active circulation. And think about it. No banks were consulted. No clearinghouses authorized the transfer. No government had the physical capacity to stop it. In a week that was totally defined by physical choke points, energy scarcity, and banking regulations, there is this parallel, invisible economy operating entirely outside of those traditional constraints.
That is profound.
So as you process the events of this week, ask yourself, what happens when the legacy financial system is forced to fully integrate with a network it cannot physically control, regulate, or shut down?
That is a fascinating question to leave on. Well, thank you for joining us on this journey through the underlying mechanics of our world. We'll see you next time on The Week That Was.